Hello, my friends. Today is September 13th, and this is Markets Weekly. This past week was almost a perfect week in markets. We basically saw the major stock indexes go up almost every single day, with the S&P 500 and the Nasdaq making new all-time highs. Looking at other markets, gold, of course, shining, making new all-time highs. Silver did pretty well as well. But really, the star of the week has to go to Oracle, which is a large stock, but basically went up 40% a day after its earnings release, trading like a penny stock. And why was it up so much? It basically told everyone that, we have all these bookings that are that suggest that our revenue is going to go to the moon in the coming years, and apparently the market liked that. It seems that stories afterwards revealed that OpenAI was the company that contracted with them. So, maybe OpenAI is going to give them a lot of business. Earlier, of course, we also know that OpenAI signed a deal with Broadcom to make chips, made Broadcom stock go to the moon. But we also must keep in mind that OpenAI has about 12 billion in revenue, and that is less than their costs. So OpenAI does not make any money. So those are a lot of big checks that they have written in the future that they will have to grow into. And whether or not they will do that, we will find out in the coming years. In any case, today let's talk about two things. First off, we have to talk about the huge data that we got the past week when it comes to inflation, and a little bit when it comes to the jobs, because those data points move the market. And secondly, let's talk a little bit about the latest happenings in the euro, dare I say, sovereign debt crises. All right, starting with the data. So as we all know, this past week was an inflation data week. We got PPI, we got CPI, and both of those were actually kind of surprising. So first off, starting with PPI, remember last month PPI totally surprised to the upside, much higher than expected. And before anyone embarrasses themselves, please remember PPI does not include imports, so it does not reflect tariffs. However, this week PPI was actually surprisingly cold. It was in some metrics negative. So another way to look at this, if you average this month's PPI with last month's, you get something kind of more normal. But PPI usually very boring. What people really care about is CPI. And CPI was also a bit surprising. It actually printed a little bit hotter than expected. Now, to be perfectly honest, I'm actually kind of bored about looking at these inflation prints, because if you zoom out a bit, it's pretty clear that inflation is basically about 3% according to CPI, and it has been for many months. Before the pandemic, we were at 2%, sometimes a bit below, sometimes maybe a little bit higher, but now that's really moved up to 3%, and it really hasn't gone anywhere. Looking at the details at the CPI report, you can see that there have been some notable jumps in, say, food, up notably, shelter a little bit higher, but really, I think that misses the point. Every CPI report we look at, some higher than expected, some lower than expected, but the bigger picture is we're basically at 3% and don't seem to be going lower. Now, many commentators also noted that the tariff pass-throughs don't really seem to be very strong. In fact, Bloomberg economist Anna Wong suggests that maybe the most intense part of a pass-through, maybe it's already occurred, and maybe in some cases companies are seeing that demand isn't really there, and so they're choosing to eat the costs by having lower profit margins. Now, zooming in on a month-over-month basis, it was higher than the past 3 months, so there could potentially be some mild acceleration, but again, it's only 1 month. Again, as we've always talked about, what the market really cares about is not PPI, not CPI, but PCE, because that's what the Fed cares about. Now, PPI, CPI, different components feed into PCE, and everyone has their little different estimates. Now, according to the Cleveland Fed, it looks like PCE this month is going to be, on a year-over-year basis, 2.99, so basically 3%, and also basically where it's been for several months. Again, it's the same story. Inflation seems to have stabilized at around 3%, and there's no clear path to get it down. However, even though it seems like inflation was, not great news, but the markets actually had a pretty strong reaction. You can see that the 10-year yield went all the way down and basically touched 4%. But that wasn't really because of inflation data, it was because of the jobs data. At the same time CPI was released, we also had initial jobless claims, which everyone has been watching closely to see whether or not the labor market will continue to weaken. Now, to the surprise of many, the initial jobless claims surged by a lot, and that really caught the market's eye. What we've seen in the past few years, well, actually for many years, is that the labor market tends to move in a nonlinear way. So when it starts to crack, it cracks very quickly. So was this that signal? Digging into the data a little bit, it seems like the jobless claims are mostly centered in Texas. So it could be just some kind of idiosyncratic data issue. So it doesn't seem like something to worry about too much. Continuing claims also, didn't really seem to jump around where it's been over the past few months. So, all in all, the market is seizing upon the weakness in the labor market and just kind of inflation that's at least not accelerating too much, and pricing and more rate cuts. And it seems like the equity market and other markets are responding to this as well. We did see a little bit of dollar weakness, and of course, the precious metals soared. Now, heading into next week, the market is pretty convinced that we're going to get a 25 basis point cut. There are whispers by people in the markets about a 50 basis point cut. I don't think that's going to happen. I think probably newly sworn in Governor Myron is probably going to dissent and vote for 50, but my guess it's just him. So, but I think going forward, looking beyond, my sense is the market is getting too aggressive with its rate cuts, and what I'm going to write about this week is why I think we could have what's perceived to be a bit more of a hawkish surprise. So we'll find out next week, and of course I will be back to give you my thoughts on the FOMC. And the last thing I want to talk about is, of course, the ongoing saga in Europe. As we all know, France was finally downgraded by the ratings agencies on Friday from AA to single A. But of course, that will not be market moving because the market already priced that in long ago. If you look at French oats trading as a spread to German bunds, it's been steadily widening. The ratings agencies are always slow, and they merely mark to market what the market already knows. So at the moment, it looks like things are going to, probably not get better. So as we all know, Prime Minister of France quit because he could not get his agenda through, and now they're going to have to figure out a path forward. Now, a couple common paths. One, of course, is that Macron can call for a new election in a legislature. Hopefully, whoever wins will have a bigger share of the legislature so they could put together a plan. But of course, he did that last year and it did not work out. And of course, what the opposition parties hope is that Macron will quit. But of course, Macron is not going to quit. So we're going to have this impasse, and we'll figure out how they finally struggle through. But I think the bigger point is that there's just no political will to do the difficult fiscal reforms that would lead France into a more sustainable budget trajectory. And it's not just France. This is basically true in all actually rich countries, right? In the US, you want to have reform of Social Security, basically impossible. In the UK, also very difficult as well. In fact, there's a very interesting article in the FT the past week, and it shows a graph where in the UK and France, you can see that seniors have been really doing very well over the past few decades compared to young people. In the UK, they actually have something called a triple lock pension, where seniors can receive the highest of 2.5%, inflation, or wage growth. So no matter what happens, whether or not there's a burst in inflation, whether or not there's deflation, whether or not there's just a huge jump in wage growth, the seniors will get to reap that benefit. Sounds really sweet, and I'm sure the politician who promised it got a lot of votes. But at the moment, the UK finances not really great, and that just might not be sustainable. Now, another graph in the FT that I found really interesting is it shows how well seniors do relative to working people, whereas the 100 is what the typical working person does in the country. And you can see in France, a retiree actually is, from an income perspective, better off than someone who works full time. So that dot is slightly above 100, whereas in all other countries, you see a more normal pattern, whereas when someone stops working, they obviously make less money than someone who still is working. So again, we all know the French pension system is very generous, but it looks like it's super generous. So now, this all is ultimately both an economic and a political problem. It's an economic problem because looking at the fiscal deficits in France, in the US, in the UK, this is not sustainable, and you're beginning to see the bond market react to some way. But of course, it's a political problem because these are benefits promised by the state, and they can only be taken away by the state. And in order to do that, you need to have political will, and that's very difficult because seniors, they vote basically, they have a very strong political force, and they vote against that. Now, when I think of the situation in the US, it's also pretty clear that seniors hold a lot more political power, not just because they vote, but because they actually sit in many influential seats, right? And President Trump is old, so was President Biden. And if you look at Congress, many people, like Nancy Pelosi, like Chuck Schumer, they're also very old as well. So very much the seniors control the political power, and because they rolled the wealth boom up over the past few decades, they also have all the money, which of course translates into political power. And this is true across the developed world. So in order to have changes to make the country be on a more fiscal, sustainable trajectory, that's just really difficult. So what everyone is doing instead is raising taxes and importing more people, trying to just kind of kick the can forward. But of course, raising taxes after a certain extent makes things worse, and you see that already. In Europe, taxes can still go up a lot in the US. And of course, you see that importing a lot of people from other cultures and religions has not been very good for social stability. So at the end of the day, there's really only one solution, and that is that benefits have to be cut for the elderly. That's only going to happen with significant pain. I would say that in the US, it's still possible for us to grow out of this, and simply because the US just has a lot more growth in technology. But then what happens historically is that you just kind of make more promises when you have more growth. So this is something that is coming to head in the markets. I don't think it's going to manifest in higher yields because the authorities can always control that. It's probably going to have a bigger impact on things like currencies, and probably explains partially the ongoing rise in gold. All right, so that's all prepared for today, and I'll talk to you all on Wednesday, I believe, when we have the FOMC meeting. All right, see you all then.